warahmatullahi wabarakatuh, and a very good morning to Madam Asmahwati. So today my group will be presenting about the introduction to the companies. So we will go to the first part, which is the introduction.
Companies in Malaysia are those entities incorporated under the Company Act 2016 or previous Company Act 1965. So an entity can be incorporated as a company under the Company Act 2016 when one or more person register the company for any lawful purpose and comply with the registration requirements of the Company Commissions of Malaysia. So we will go to the next part, which is the classifications of company. In this chapter, we will get to know the classification of company based on that Company Act, companies limited by share, company limited by guarantee, and unlimited companies, which is then fall under Section 10, Subsection 2, Subsection 3, and Subsection 10, which is the first one, company limited by share. It means that member obligation to the company is limited to the amount, if any, unpaid on share held by the member. It means that, for example, shareholders subscribe 100,000 ringgit of share capital and he only paid for 80,000 ringgit, so his liability is limited to the 20,000 unpaid on share. So it means that if they are fully paid, they don't have further liability. Next one is the company limited by guarantee. It means that member liability is limited to such amount as the member undertake to contribute in the events of the company being so the next company is a one form or under principles of having no limit placed on the liability of its member. It means that if the company is being wound up and had unserviced asset of debt, so the shareholder will contribute the asset to pay the debts of the company. So the next one is the types of a company. That could be a public company, a private company, government-linked company, and a foreign company. The first one is a public company. It's a company that other than a private company require the word berhad at the end of the name. It could be a company limited by share or company limited by guarantee. The next one is a private company. They have the word sendirian berhad at the end of their name. They cannot offer share or the venture of a company to the public, but they have the restrictions on the transfer of its share. So the next one is a private company. They are a private company with not more than 20 members, and then whose share are not held directly or indirectly by any corporation. It's a foreign company. It's a company, corporation, society, association, or other body incorporated outside Malaysia. It means that the head director of the company is not placed or based in Malaysia. So next one is the government-linked company. The government-linked company is a corporate entities in which the government owns some or all of the share capital. It could be a private company or a public company, and also at this time a government hold a stake in the company as with the holding company.
So the last part of the slide is the registration requirement. Registration requirement is a thing that we needed when a person wants to register for a company. So any person or person can submit the application for the incorporations of a proposed company. There are 7 things that we needed as a requirement to the registration. The first one is the name of the company, the status of the company, whether it wants to be public or private, the nature of the business, the address of a registered office of the proposed, biodata of each member and director, details and class and number of share taken, and the last one is the amount guaranteed by the member and other information required by the register.
Explain about the financial reporting requirement. So financial reporting requirement consists of 2 main status governing the financial report. First is Companies Act 2016 and Financial Reporting Act 1997. So the financial reporting requirement, according to the entities incorporated under the Companies Act 1965, Companies Commission of Malaysia (SSM) requires the above entities to physically file its financial statement within 1 month after its annual AGM meetings. According entities under the purview of the Central Bank of Malaysia (BNM), banking institution and development financial institution submit the interim reports and audited annual report to the BNM within 4 weeks after the end of each quarter and 90 days after end of the financial year respectively. Next is for listed companies. Listed companies shall submit to the Securities Commission in hard copies, first a copies of its audited annual accounts within 2 weeks from the date of its AGM and its interim and periodic financial reports immediately after figures are available. Next is listed companies shall also electronically announce interim reports to the Bursa Malaysia within 2 months after the end of each quarter and announce annual reports to the Bursa Malaysia within 4 months and issues the annual report to the stock exchange and shareholder within 6 months. So next is annual reports. Annual report is the financial document that a public company prepares for its shareholders. These reports can be used by potential investors and securities analysis to evaluate a company's stock. The key elements of a company annual consist of 6 items, which first, chairman's statement. The chairman letter will provide an analysis of overall business performance. Next is corporate government. Corporate government is the director are responsible for maintaining good corporate government. The third is audit committee report. This report will state audit committee area of responsibility and the manner which has carried out its duties. Fourth is statement on internal control. This statement about the company internal record. Fifth is social responsibility statement. This statement discloses social responsibility information to the company. The sixth is financial statement. This is including director reports, auditor report, and financial statement. So that's all the key for the elements of company annual reports.
Assalamualaikum everyone. So I will continue to my part, which is legal requirements in Bursa Malaysia Securities Berhad. So the first one is market capitalization totals at RM 500 million, and it is capable of showing that the business is rising optimistic and is prepared to further expand. Next, if the company goes public, both markets will expect the company to issue to the company at least 25% the company's share capital. Next one is main market companies will assign 50% of the public spread to investors of Bumi Putra status at the best possible rate. So the next one is advantages and disadvantages changes from partnership to company. The first one is limited liability. As we know, the liability of shareholders is limited to the face value of shares held by them or guarantee given by them. Unlike partnership, every partner in a partnership has unlimited liability. They are personally responsible for debts of the business. The next one is perpetual existence. Death, insanity, and solvency of shareholders or directors will not affect the company's existence. A company has legal separate entity, which is unlike a corporation, a partnership doesn't have perpetual existence. Death, retirement, personal bankruptcy, or insanity of any partner causes the dissolution of the partnership. The last one is expansion potential. As there is no limit to the maximum number of shareholders in a public limited company, expansion of business is easy by issuing new shares. For partnership, there is limit to the members in the partnership. Unlike a corporation, potential of expanding is not easy. The next one is the disadvantages. The first one is restriction. Compared to proprietorship and partnership, a company has to comply with more legal requirements than it requires time and effort. For partnership, there are no formalities for a business relationship to become a general partnership. It can either be in oral or writing to form the business. It will be more easier to build the relationship. The next one is lack of secrecy. As per the legal provisions, a company has to make various statements available to the register of the company's financial institutions. The secrecy of business comes down when it is further reduced as the company provides its annual report to the shareholders, and also competitors do also find out the details of all financial data. In the partnership, there is no legal obligation to partners to publish its financial information. If the partnership intend to keep the information secret, it is possible to maintain the secrecy of the information. The last one is double taxation. Since the corporation and the stockholders are considered to be two different legal entities, they face the problem of double taxation, meaning that the owner are taxed twice. While the partnership itself is not taxed on its income, but each of the partners will be taxed upon his or her share of the income from the partnership.
The subtopic that I want to present is about the advantages and disadvantages changes from partnership to a company. First thing first is the advantages. Firstly, the advantage is professional management. This is because the directors of a company may be elected by the shareholders, so they are from experienced well person. Second, diffusion of risk. As we all know, the members of the company is large, so when this occur, it will divide the risk into small members, into small groups. Okay. The third one is transferability of shares, and then the disadvantage. The first one is lack of personal interest. Second, the company can be expensive to establish, maintain, and wind up. And the last one for the disadvantages is the companies must pay the corporation tax. The corporation tax is based on the profit that a company receives year by year. Okay, and that's the differentiation of element disclosure, business, and entrepreneurship. First, I'm dividing the column into three: the sole proprietorship, partnership, and company. Okay, and then the first one is the structure. A structure of sole proprietorship is an individual doing his own business, partner two or more people doing business for profit, and company a legal entity separate from its member. A membership of sole proprietorship, there is only one person, while partnership maximum of 20 partners unless it is professional management. And last one is a company, no maximum number unless it is a private company. Formation for a sole proprietorship no need to be formed in writing, but for partnership can be formed orally or in writing. A company must be formed in writing through a memorandum and articles of association. Registration of sole proprietorship must be registered under the Registration of Business Act 1956, while partnership and company both must be registered with the SSM under Registration of Business Act 1956. Sole proprietorship and partnership is unlimited liability for the business debt. This is mean because the owners of the firm must pay for the losses that they cause using their own pocket money. While for a company members are not liable for the company's debt once they hold fully paid company shares. Last but not least, the formation of sole proprietorship and partnership can be dissolved informally, but for company can be dissolved formally.
Today I would like to present about differentiate the element disclosure in financial statement between company business and partnership business or sole traders. The first of all is legal entity. Legal entity of company business is a company is a single legal person, which known as body corporate. Is able to make contracts through its director or other staff. Second is partnership business. A partnership is made up of individual, anyone of whom may commit the partnership of partnership to any agreement. The partnership have a collective responsibility for all the tax of the partnership and for all other partnership debts. The partners may make their own arrangement for division of tasks, responsibility, and liability. Okay, second one is legal framework. Legal framework for company business. A company exists and perform entirely within a legal framework defined by a number of Companies Acts, which is the most important one being the Companies Act 2006. This framework will set out the duties the directors, the company as a corporate body, and the shareholders. There are rules on what information must be recorded and reported to whom often. Second is partnership business. The Partnership Act of 1890 applies to partnership that don't cover certain points in their partnership agreement, but otherwise, partners can do whatever they collectively agree. Less regulation give a partnership scope for a less formal, more flexible, and more easily changed structure. Okay, the third one is sale and transfer. Company business is a company can be divided into units or call it by shares, and those shares can be sold. This makes obtaining investment and transferring ownership easy. Company exists without their founded shareholders. If a shareholder dies, his interest can be transferred to someone, and the transfer confers the same right to the new owner. Ticket is partnership business. A partnership share can be sold, but it is usually can be restricted or made more difficult by other partners, making it share less value than the equivalent in a company. It is also hard to sell part of a share. And the conclusion is, in conclusion, we will get to define the classification of companies. We get to describe introduction to companies account, type of companies, capital structure of companies, and classes of share capital. Now we can explain about the types of company and company formation, and we get the knowledge of legal requirement and financial reporting based Companies Act 2016 and Financial Reporting Act 1997.